Right now, while you're watching this video, someone your age, maybe younger, just made more money sitting on their couch than you'll make this entire month at your job. And no, they didn't win the lottery. They didn't get lucky. They understood one thing that most people never learn: how the stock market actually works. And by the end of this video, you'll understand why millions of Americans invest every single month, even when the market is crashing. Here's the uncomfortable truth: the vast majority of long-term wealth is built by owning assets, not just trading hours for dollars. And the stock market? It's the single most powerful wealth-building machine ever created by humans. A small investment in Amazon right after its IPO would have grown into millions of dollars over the following decades. It's made teachers, nurses, and bus drivers into millionaires, quietly, without headlines. But here's the part that should scare you a little. Every single day you wait to understand this system is a day someone else is using it to get richer, while you're getting further behind because of inflation eating your savings alive. So stick with me for the next few minutes, because by the end of this video, you're going to understand exactly what the stock market is, how it actually works behind the scenes, and why the people who get it early almost never stay broke for long. Let's get into it. Let's clear up the biggest myth first. The stock market can feel like a casino, but only if you treat it like one. At its core, the stock market is just ownership. That's it. Imagine your friend opens a coffee shop. It's doing well, but she wants to open 10 more locations. She needs money to grow. So she comes to you and says, give me $1,000 and in return, you'll own 1% of my coffee shop business. If it grows, your 1% grows with it. That's literally what a stock is: a tiny slice of ownership in a real company. When you buy a share of Apple, Tesla, or Coca-Cola, you're not just buying a piece of paper. You now legally own a small fragment of that entire business: their factories, their brand, their future profits, all of it, proportional to your shares. Now, here's where most people get confused. Companies often go public to raise capital, give early investors liquidity, and fund future growth. This is called an IPO, an initial public offering, when a company first sells shares to the public. Quick pattern interrupt. Have you ever wondered why it's called going public? Because before that, the company was private, owned by founders and early investors. Going public basically means, hey world, want in on this? And that single moment can turn founders into billionaires overnight. Many of the world's richest entrepreneurs became wealthy primarily because they owned shares in the companies they built, not from a salary. So remember this: the stock market isn't about luck. It's about owning pieces of real businesses that make real money. But owning a stock is only half the story. The real question is, how do these little pieces of ownership actually get bought, sold, and priced every single second of every single day? That's where things get interesting. Picture the New York Stock Exchange, or NASDAQ. These are stock exchanges, basically giant digital marketplaces where buyers and sellers meet to trade ownership of companies. Think of it like the world's biggest, fastest, most chaotic auction house, except instead of paintings, they're auctioning tiny pieces of Apple, Microsoft, and thousands of other companies. Here's the part that blows people's minds: stock prices are not set by the company. They're not set by the government. In the short term, prices are driven heavily by supply, demand, fear, and greed. Human psychology playing out in real time, millions of times a day. But over the long term, business performance matters most. Now, you personally can't just walk onto the trading floor and start buying shares. You need a middleman, a broker. Today, that's usually an app on your phone. Think Fidelity, Charles Schwab, or Robinhood. You open an account, deposit money, and place an order to buy a certain stock. That order gets matched electronically with someone else's order to sell in a fraction of a second, and boom, you now own part of that company. But here's a question that should make you pause. What actually makes a stock price go up long term? Not day-to-day noise, but real, sustained growth? The answer is earnings. If a company sells more, makes more profit, and grows its business, more investors want in, demand rises, and the stock price climbs over months and years. This is why legendary investors don't panic over daily price swings. They're focused on the actual business behind the ticker symbol. Ironically, the market isn't designed to punish beginners, it punishes emotional decisions. Most beginners watch a stock jump 5% in a day and think they found a get-rich-quick scheme. They panic sell when it drops 10% the next week. They're playing a short-term guessing game instead of understanding the long-term machine. And that mistake alone has cost regular people just like you, thousands, sometimes hundreds of thousands of dollars over their lifetime. So if daily price swings are mostly noise, what actually separates the people who build real wealth from the stock market, from the people who lose money and swear it's rigged? That answer is coming up next, and it might completely change how you think about investing. Here's a number that should either excite you or terrify you, depending on what you do with it. Historically, the US stock market has averaged around 10% annually over the long term, although returns vary significantly from year to year when you look at broad index funds like the S&P 500. 10% doesn't sound dramatic, but this is where compound growth becomes almost unfair in your favor. If you invested just $300 a month starting at age 25 and let it grow near that historical average by the time you're 65, that could potentially grow to around or even over $1 million, depending on actual market returns. Not from getting rich quick, not from picking the next hot stock, just from consistency and time. Meanwhile, someone who starts the same habit at 35 instead of 25 could end up with significantly less, same monthly amount, same return, just because they waited 10 extra years. Time in the market is the closest thing to a cheat code that actually exists. But, and this is critical, the stock market is not risk-free. Companies can fail. Markets can drop 30, even 50% in a bad year, like in 2008 or early 2020. This is real money, and losing it is a real possibility if you invest carelessly, chase hype, or put everything into one single stock hoping it's the next big thing. This is exactly why diversification exists, spreading your money across many companies through index funds or ETFs, instead of betting everything on one company's fate. It's the difference between betting on one horse and owning a piece of the entire racetrack. Here's the part that should light a fire under you. Every year you delay starting out of fear, confusion, or simply not understanding the system is a year of compound growth you can never get back. Not next year, not in 5 years, never. The market doesn't wait for you to feel ready. It just keeps moving, with or without you in it. But before you go download a trading app and throw money at the first stock you recognize, there's one massive mistake almost every beginner makes. A mistake that has nothing to do with which stock you pick and everything to do with what's happening in your bank account before you even invest a single dollar. Here's the truth nobody tells beginners. The stock market doesn't care how excited you are. It doesn't care how many videos you've watched. What actually determines whether you build wealth or end up stressed, pulling money out at the worst possible time, is whether your financial foundation can actually support investing in the first place. If you're investing money you might need next month for rent, or money you'll panic withdraw the second the market dips, you're not investing. You're gambling with a time bomb. The investors who actually build life-changing wealth aren't the ones who found some secret stock. They're the ones who got their cash flow in order first so their investments could grow undisturbed for years without emergencies forcing them to sell at a loss. So here's the real question you should be asking right now. Is your money actually organized well enough to start investing safely? Or are you one unexpected expense away from wrecking your own progress? Most people don't know the answer. And that gap is exactly what separates people who talk about getting rich from people who quietly become wealthy. If you don't fix your cash flow first, the stock market can become your biggest financial mistake instead of your greatest wealth building tool. I've made a complete video breaking down exactly how to manage your cash flow the right way, so your money works for you before it ever touches the stock market. Watch that video next. See you there.